Hi everybody, it is Monday, September 15th, 2025. Our episode starts with our headline, 10-year Treasury note yield expects a hawkish Fed. And this is while Mr. Market enters euphoria. SPX, the S&P 500, rose by 0.5% today, closing at a new all-time high, breaking all trend lines, going on this type of euphoric run that often functions as a last, final gasp before things fall apart. At least that's the way I'm seeing it. The reason I'm saying the 10-year is expecting a hawkish Fed is because, as you can see here, the 10-year minus 3 month is still inverted. We're still negative here. This is saying that even though cuts are expected over the next few months, it is not expected for the next 3 months to be dovish enough by what the 10-year is saying to the market. The 10-year staying at a yield that is lower than the current 3-month Treasury note yield. It might feel like the Fed is getting dovish. After all, we are cutting here without inflation getting down to their target, yet the 10-year says no, we still need, in fact, more cuts. Moving on to our community topics. What moves, if any, did you make today? Robschild buys more Target stock. Personally, I think Target stock is way below what I consider to be a fair price at $130 a share. This is a 10-year average PE of only 20. And you could argue that it deserves an average 10-year PE ratio of 25. It being a leader in the retail industry. Right now, we are almost a third below a price that is very conservative in my strong opinion, so I'm getting more of it. I want to add in right here that tomorrow we do have retail sales information coming out. It seems to me that the market is front-running this as being a bad report since XLP consumer staples plummeted today 1.15%, closing below any kind of support that we've had in recent months. Did the info get leaked? Are the dumpers of XLP and Target, do they know something that the rest of us don't? I can't make any assumptions on that, but I find it interesting. Second community topic, I had a missed show over the weekend. I didn't do a show Friday, Saturday, or Sunday if you happen to be looking for it. It's because I got a new computer. I built it myself. Took me all day Saturday to build it. Seems to be working all right. Also, that's why the setup looks a little bit different today. Coming up tomorrow, Tuesday, like I had stated earlier, we do have retail sales coming out. This can rock things around. We also have a 20-year bond auction that can give us a taste for appetite for Treasury debt. We need to talk about that chart, by the way, 10-year Treasury note yield doing some very interesting things. We'll get to that chart pretty soon. We also have Wednesday, the big FOMC meeting. It's expected with almost 100% certainty we're getting a 25 basis point cut. I'm starting to wonder if that 3% is a little complacent of there being no cut, or is that a double cut? Oh, no, sorry. For a double cut, actually. Almost 2.5% of 2 cuts. I only say it's complacent because, why are we cutting when the stock market's at an all-time high? And also, yes, there's cracks in the jobs market, but is it falling completely apart yet? Is this an appropriate move for the Fed? I mean, the 10-year Treasury note yield, like I said earlier, is clearly showing that it wants more cuts and that the assumed coming cuts are actually not enough while, staying in an inverted state. But I guess we'll see what happens. And then on Thursday, we have weekly jobless claims and a big report, the LEI, Leading Economic Index. This has been falling, and the last report reported that it has been falling 6-month to 6-month period at a faster rate. This is a huge warning sign for the economy. And yes, I know the economy and the stock market aren't the same thing, but what typically happens in a very weak economy is you get forced sellers. You have people that have to sell, not because they want to, but because they have to. And that picks up when the economy is falling apart. Anyway, we also have continuous tariff updates coming up. Thank you for watching, liking, subscribing, commenting, and supporting. See my website in the description to read through my macro daily view reminder and my portfolio explained. With the S&P 500 going up today, one of the updates that I didn't put on the website yet is that the S&P 500 was extremely expensive, and it's even getting more expensive, which can happen when you get into bubble territory, with the S&P 500 being at a current PE ratio of 31 and a CAPE ratio of 40. Obligatory reminder, this S&P 500 can and has dropped several times in history to below 10 in the CAPE ratio, which would be 75% lower in price than it is currently right now. But hey, what could possibly go wrong? On to the charts. Back to the S&P 500, the SPX closing at an all-time high over 6,600. The problem with bubbles is you really don't know how big they can get before they inevitably burst. But here we are, sitting at all-time highs, going into the first rate cut. Obligatory reminder, when the federal funds starts their cutting cycle, this is often the very beginning of a recession, and it has been working like clockwork since 2000. Soon as we start the cuts in November of 2000, boom, boom, boom. Few months later, the dot-com bust, this gray bar being a recession. Same thing, great financial crisis. Going into it, we were about to cut when we saw a little bit of weakness. July 2007, August was our first little cut there of 25 basis points. And what happens after that? We had to aggressively all the way basically to zero by January 2009, because of how bad things were falling apart. And it's not just those. Pretty much all the time in history, when the Fed starts the cutting cycle, that's when the recession begins. And here we are, starting the cutting cycle on Wednesday. It starts this week, guys. So careful out there. For those of you that think the stock market can only always go up, it can go up and it can also go down. Please be reminded of that. And never any investment advice on this channel. With shorter end rates dropping, HYG was able to go up, but when you strip out SHI, which is the government equivalent bond yield, bonds, we still broke higher. So this is suggesting that the credit market is saying, yeah, junk bonds, we're gobbling them up right now. This is literally, in my opinion, the worst possible time in history to be gobbling up junk bonds, and here we are. Amazing stuff, guys. It is important today that today's stock market rally was not broad-based. It was mostly the popular mega cap names that really drove the markets higher. You can see a large portion of the finance industry, most of health technology, consumer non-durables all went down. You see a lot of red in these little tiny companies and a lot of green in these big ones, which is why we have such a big difference of the price going up in the advanced decline line and the advanced decline line going down. And so this is suggesting that, it is possible that we could be at a top here. Next, I brought up the U.S. 10-year Treasury note yield as forming a very interesting pattern. And yes, it is. Okay, so we have a very, very, very clear bear flag looking thing. It's not angled properly. Ideally, you want your flag to be upsloping or at least flat, and it seems to have been downsloping a little bit. So that oddly enough, that sort of weakens it a little, but I think what's going on here more than anything is the fight is here at the 4% level. We're fighting in a range between 4.09% and 4%. The reason bear flags play out to the downside is because we moved all the way down here, and if there weren't sellers just waiting to get out of 10-year Treasury note yields, we would see it go straight back up. And we're not seeing that. We're seeing a flag motion saying that the buyers of longer dated Treasury debt are stepping in every time it goes up. They're buying it back down. It goes up. They're buying it back down. And that's why you get this chop at the bottom of a flag that usually ends up breaking down to the downside. It's what I'm expecting, but we'll see what happens. Next, Bitcoin. If you remember from Thursday's show, we talked about this inverse head and shoulders that has been playing out. We broke the neckline, we went up, and it looks like we might retest this neckline here, this yellow neckline. I don't know if you can see it too well. All right, that's better. So the target on this pattern, if it plays out like it normally would, inverse head and shoulders, is to go back down to this trend line here and then get to its target, which is actually $119,500 per Bitcoin. If and when we get to this area, I'm going to go back into shorting Bitcoin in this area right here, 117 to 119. I think it's notable Dr. Copper with a PhD in economics is still in this channel. We rose today a good amount, now at 473. We've been in this channel so long, it's hard to say how long this will continue. I imagine it continuing until Dr. Copper decides to do something a little more decisive. It still sure looks like a bear flag, although the flag's getting so long at this point that, we start not favoring one way or the other once we go far enough in it, other than it just being an ascending channel, which an ascending channel typically actually breaks down to the downside anyway. But it could go on for a while. Certainly, if we do get into some very recessionary type data, Dr. Copper might take a dip. But yeah, we're going higher and higher highs, higher lows. What else can you say? Speaking of metals going up, gold getting again to an all-time high. We're past the close now. Closing and confirming above this stopping tail that was looking pretty bearish, and now it's looking bullish. Gold looks like it's going to keep going higher now, just from a chart standpoint. Just to remind everybody why Robschild always says that gold's in a bubble. You need to ask yourself, how much copper should you get for how much gold? In any civilization, in any time period, there's copper that's needed for things and there's gold that's needed for things. How much copper should you get for gold? Right now, I think it is extremely, extremely important to realize that since 1850, over at least the past 175 years, copper has never been cheaper compared to the price of gold. I find this to be one of the most fascinating charts out there that no one seems to be talking about or caring about at all. And I'm just flabbergasted. I also noticed today silver making new highs, going higher and higher. It does turn out that this bull flag looking thing was a bull flag, I guess, and broke to the upside. Funny enough, this pattern reminds me a lot of the upside down of the 10-year Treasury note yield, does it not? With, not it being a very clear flag, but still playing out that way anyway. That's all I have for you today. That's all from me and my crystal ball. I hope you enjoy. Thank you for watching and see you next time. Robschild.